Investing in your knowledge will always be one of the most rewarding decisions you can make. Despite this, many people neglect their financial education and, as a result, experience losses through wrong decisions. This process often translates into a constant and exhausting effort, where long hours of work are dedicated to activities that barely contribute to improving their financial situation. What many ignore is that acquiring a solid understanding of financial principles, tools and rules can bring significant and positive changes to their economic status. If you want to dig deeper into these tools, this content is for you. Today we will explore the 12 must-know financial tools and rules that can effectively ground and improve your finances. So, if you are ready, let's get started. 1. Statement of financial position. The first step in financial literacy is understanding the statement of financial position. For those who are not familiar with accounting terms, this concept may seem complicated. However, what you really need is to know not only how to prepare it, but how to analyze it correctly. You could compare it to a medical checkup. A doctor performs several tests on you to provide a clear diagnosis about your health. Similarly, a statement of financial position gives you a clear view of your assets, liabilities, and net worth. For example, let's imagine Luis, who has savings in the bank, a house, and a vehicle. Looking at his financial statement, you can see that he has $5,000 in savings, a house valued at $100,000, with an outstanding mortgage of $50,000, and a vehicle valued at $15,000. Adding it up, Luis has assets totaling $120,000. His liabilities equal $50,000 of debt on the house. All told, his net worth would be $70,000. This tool provides a clear diagnosis of Luis' financial health and allows him to assess how he can grow his wealth over time. 2. Income statement. The income statement is another vital tool, as it provides an analysis of income and expenses. The key to building wealth lies in increasing your income and, more importantly, increasing your profits, which are your income minus your expenses. This tool shows you not only what you are earning, but how much you can save and, therefore, invest. Let's take two individuals as an example. One earns $5,000 a month and has expenses of $4,000, leaving him with $1,000 left. On the other hand, another individual has a salary of $3,500 with expenses of $1,500, resulting in savings of $2,000. Despite the lower income, the second person will be in a better financial position to build wealth twice as fast. This tool helps identify areas where benefits can be increased and thus accelerate wealth growth. 3. Cash flow. This tool is crucial to understanding how money moves over a given period. It allows you to assess cash inflows and outflows, as well as your liquidity. By having clarity on what money is coming in and going out, you can make informed decisions that will prevent liquidity problems in the future. We must seek to increase income and reduce expenses to obtain a positive cash flow, which will give you more capital to invest. If your income depends on a job, it is advisable that your cash flows not only come from your work time, but also from investments and assets that generate passive income, a key factor in achieving financial freedom. 4. Budget. Creating a budget is essential to keeping your finances under control. While there are a multitude of tips on how to make a budget, the essential thing is that it helps you clearly identify your income and expenses. Organizing your money before you receive it is a crucial step that allows you to plan your financial goals. Money management cannot be done properly if you don't have control over it. Many people live month to month waiting for their next paycheck, without a clear plan, which leads them to fall into impulsive spending. Remember that true wealth is not measured by how much you spend, but by how much you manage to invest and accumulate. An effective budget should include both fixed income and expenses you can foresee, helping you project the use of your money. 5. Compound interest. Compound interest is a powerful tool that many underestimate. This financial principle involves earning interest on principal as well as on previously earned interest. Investing a small amount consistently can yield significant returns over the long term. You can start benefiting from compound interest even by investing through mutual funds that track a market index, such as the S&P 500, which can provide you with returns of 8 to 10% annually. People are often intimidated by the stock market, thinking it requires extensive knowledge in data analysis and charting. However, engaging in passive trading does not require an extensive educational background and can be a very effective strategy for accumulating wealth. 6. Rule 72 of investments. The Rule of 72 is a handy tool that lets you estimate how long it will take to double your investment at a specific rate of return. Simply divide 72 by the expected return percentage. For example, if you plan to invest $2,000 at a rate of 10% per year, dividing 72 by 10 will give you approximately 7.2 years to double your investment. This rule is not only useful for evaluating investments, it also helps you focus on more profitable options that can accelerate your growth. 7. 50/30/20 Savings Rule. This rule provides a simple framework for organizing your spending. The strategy involves allocating 50% of your income to basic needs, 30% to variable expenses, and 20% to savings. While it can be difficult to stick to this ratio exactly, the basic approach of allocating a percentage to savings before spending is key to building a solid financial foundation and laying the groundwork for future investments. 8. Diversification and Rule 110. Diversification is a fundamental principle in investing. The Rule of 110 suggests that you should subtract your age from 110 to determine the percentage of your investment that should be in equities. For example, if you are 30 years old, you should invest 80% in riskier assets, stocks, and 20% in safer investments, bonds. This approach helps balance your risks as you age, ensuring that your portfolio becomes more conservative as you approach retirement. 9. Risk and profitability. It is important to remember that the greater the potential for profit, the greater the risk. Before making an investment, consider your risk profile, your ability and willingness to accept losses. Knowing your risk tolerance is essential to avoid decisions that could jeopardize your assets in the long term. 10. Tax planning. Tax planning becomes essential as your wealth grows. Many fail to consider the impact of taxes on their path to wealth accumulation. Timing your investments and spending to minimize your tax burden can be critical to avoiding unpleasant surprises and ensuring you don't pay more tax than necessary. Educating yourself about tax deductions and credits can make a significant difference in your tax burden. 11. 30% Debt Rule. Finally, it is advisable to keep your debt below 30% of your monthly income. This rule of thumb helps to avoid over-indebtedness problems and preserves your financial health. Although in the business world debt can be used to leverage growth, in personal finances, it is vital not to commit more than 30% of your income so as not to affect your ability to pay your debts sustainably. Conclusion. Each of these tools and rules is vital to building a solid foundation in your financial education. Good management of your finances can not only protect your resources, but also open doors to new investment and growth opportunities. Familiarizing yourself with these concepts will allow you to make more informed decisions and design a path to financial freedom. The combination of knowledge, planning, and discipline is essential to transform your financial situation and achieve your long-term goals. Remember, financial education is the first step towards a prosperous and secure future.